Hello, this is Jackie Jones, and this video is just a brief introduction to trust accounting. It is not a complete overview, and it's very important that you listen to the trust accounting lecture and consider all the material that is posted online, as well as the workshop tasks that are on this subject. Importantly, if you have a question after you have considered all the material, listened to the lectures, etc., post it on the discussion board so that you and other students can have the benefit of that question and answer. It's important to remember that you're undertaking this trust accounting component of the subject because of the requirements of the Legal Profession Admission Board, and slide on the screen details the competency that you are to meet. Now, it's quite a simple premise, and that is that trust money is not your money, and that the trust money of each client of a firm needs to be kept separate from your money, the firm's money, and other clients' money. And the way it's kept separate is through accounting processes and documents. And it's important for this aspect that you read and become familiar with the trust accounting regulations. So there on the slide on the screen clearly states that when money comes into a firm, it's in two distinct categories. It's either the client's money, and in that situation it just must go into trust account. There's no ifs or buts. Alternatively, money coming into a firm might be the firm's money, and if that's the case, then it can go into the firm's office account. Now, this slide has a little bit of a flow chart just to get you having an appreciation of what happens when a client comes in to a firm with money, or alternatively, the firm receives money on behalf of a client. That money has to be placed into the trust account, and that's where it will remain. Now, when it's put into the trust account, there needs to be a completion of various accounting records, and when it comes in, you will need to have a trust receipt issued, and then details of that money deposited on behalf of that client will be recorded in that particular client's trust ledger. The money will stay in the trust account until it's removed with the client's authority for payment of either professional costs or expenses such as disbursements. Now again, money out of the trust account needs to have accounting records. So there needs to be primary documents from an accounting perspective that show the money being removed from the trust account. Now, this slide illustrates that even though each solicitor's firm, has only one trust account with the bank, there are numerous ledgers for all the clients in that firm that exist for the trust account as well as the office account. So even though there's only one account with the bank, it is the accounting records that set up the various trust ledgers for all the clients. Now, there's a couple of points to remember. Sometimes we need to do a trust statement to a client, and that trust statement is a record of all the money that's paid into the trust account for a client, as well as all the money paid out. Now, money in and money out must balance, and that money in and the money out has to be recorded somewhere, because remember, the firm only has one trust bank account with the bank. So there has to be a recording of whose money is what within that one bank account, and that's the accounting records, and that's where the ledger for each client details the money that's come in on behalf of that client and the money that has gone out on behalf of that client. Now, it's common that we as solicitors are going to send a bill of costs to a client, and that bill of costs will include professional fees, namely our fees, our costs for doing a legal service to a client. It will also include disbursements, monies that have been paid to third parties. It might be a filing fee to a court, it might be a process server fee, it might be a registration fee to lodge a dealing, might be all sorts of things that it could be a disbursement. Now, importantly, if there has been money in the trust account and that money has been used with the client's authority to pay disbursements, then those disbursements don't then appear on another document, namely the bill of costs, because the client's money has been used to pay that disbursement and they don't get charged what will then be a second time by it being included in the bill of costs. Now, office account ledgers and trust account ledgers are used to prepare the bill of costs to the client, because you need to know what, if any, disbursements have or have not been paid for the client. Now, it may be on a bill of costs that you refer to money in trust. Sometimes there might be less money held in trust and there'll be an amount of money. So that would be used with the client's authority to pay the bill of costs. The office account is the same as the trust account. Each firm has an office account and there are individual office ledgers for each client. Again, it is the accounting records that separate the office ledger for each client. Now, the office account is the firm's money. It's where the money is drawn for wages, it's where the partners take their drawings, it's where costs of the legal firm are drawn from, such as the payment of lease or expenses associated with the running of the firm. Trust money cannot go into the office account unless it is authorised. Now, this slide are just a couple of key points for you to think about. When money comes in from the client, first of all, is it trust money? Must it be recorded, and if so, where? Is it a payment of a bill of costs? If so, what can happen to it? And then secondly, think about what is the process to use trust money, money that is in a trust account for a client. You have to have authority. Who does this come from? Does the legislation assist? And what must be recorded, and where must the money coming out of the trust account be recorded? A little bit of a ready reckoner of things for you to think about as we approach trust accounting. Finally, just a note of caution, trust funds are not your money, and there's just a couple of examples of what's happened to lawyers who have used money in the trust account. Interestingly, the one where the client was sentenced to 3 years for misusing client's money, that money was originally received under the agreement from the client that it would be paid to the Office of State Revenue, and the client used those funds without the authority of the client, that money being deposited for a specific purpose. So I hope that this very brief introduction to trust accounting has settled some nerves and puts into perspective a little bit of what we're going to be looking at for trust accounting. Thank you.